The stock market should have already crashed. Every alarm is screaming. Every historical pattern is flashing red. Yet the stock market keeps climbing higher. I'm Tim, and I have analyzed markets for long enough to know that the markets don't care about your predictions or mine. But I also know that history doesn't repeat. It rhymes. And right now, it seems like history is about to rhyme harder than before. Today, we're going to expose the 3 hidden forces that are artificially propping up this market. Because the uncomfortable truth is this: Wall Street doesn't want you understanding why the crash hasn't happened yet. Because once you see these mechanisms clearly, you'll realize the delay itself is the most dangerous part. Let's start with the numbers that should terrify anyone paying attention. Warren Buffett has a favorite metric. It's called the Buffett Indicator, and it compares total stock market value to the size of the entire US economy. Right now, that number is screaming danger. US stocks are worth roughly $66 trillion. The entire US economy produces about $30 trillion in GDP. Do the math. That's around 220%. Anything over 100% is considered dangerously overvalued. Before the dot-com crash in 1999, this ratio peaked at 153%. The market then collapsed by over 77%. We're at 220%. Let that sink in. But it gets worse. The concentration of risk is extreme. The S&P 500 historically trades at PE ratios around 15 to 16. Today, we're running 25 to 28. But the real insanity lives in individual stocks. Nvidia's PE ratio sits at 53. Tesla, an absolutely mind-bending 286. Investors are literally paying $286 for every dollar of earnings Tesla produces. This isn't investing, it's speculation on steroids. This is exactly the kind of madness that Isaac Newton described after he lost his fortune in the South Sea bubble. History doesn't just rhyme here, it's practically singing the same song. Here's force number 1, the money flood. So why hasn't the crash happened yet? The first reason is the most insidious: currency debasement. The government issues massive debt. The Federal Reserve accommodates it through digital money creation, what they politely call quantitative easing. But here's what they don't tell you. This money doesn't flow evenly. It flows first to the financial system. Banks, governments, and asset owners get the fresh money first. This is called the Cantillon effect, and has been rigging the game for around 300 years. The top 10% of the households own nearly 90% of all stocks. When the Fed prints money, asset prices rise. The rich get richer. Meanwhile, everyone else gets inflation. This isn't a bug in the system. It's the feature. Inflation rewards those who buy assets with debt and punishes those who save cash. You're being systematically incentivized to speculate or lose purchasing power. Those are your only options. The second force holding this market up is even more dangerous. It's extreme concentration, amplified by passive investing. The market's gains are completely driven by a handful of AI companies: Nvidia, Microsoft, Apple, Meta. These giants represent unprecedented valuation concentration. Their stock prices assume decades of perfect execution and exponential growth. Now, add passive investing to the mix. Over 50% of the S&P 500 is now owned by passive index funds. When you buy an index fund, you're not making investment decisions. An algorithm is, and that algorithm doesn't care about fundamentals. In a rising market, this creates a beautiful feedback loop. Money flows in, algorithms buy, prices rise, more money flows in. But here's the crash mechanism nobody talks about. When the market turns, those same passive funds are mandated to sell proportionally. The bigger the stock, the more violent the selling pressure. This structure, which Wall Street loves in good times, ensures that when the market falls, it'll fall faster and harder than anything we've seen before. And here's one of the most powerful forces. Force number 3, the shadow banking shell game. Now, for the reason Wall Street really doesn't want you to pay attention is its regulatory arbitrage. After 2008, laws like Dodd-Frank were supposed to make banks safer, and on paper they did. Regulated banks look stable and compliant. But here's the trick. Major financial institutions simply moved their riskiest exposures off their balance sheets. They shifted high-leverage lending into what's called the non-bank financial intermediation sector, or shadow banking. This $4 trillion shadow banking system isn't subject to the same capital rules as commercial banks. The risk didn't disappear. It just moved somewhere the regulators can't see it clearly. Leveraged loan default rates are forecast to hit 3.5% to 8.2% in 2025. That risk sits entirely in the shadow sector, allowing conventional banks to look pristine. This is a loophole written large enough to drive all of Wall Street through. The system looks stable because we're measuring the wrong part of the system. So here are the 3 phases of collapse. Markets don't just crash randomly. There are phases to it. There's a psychological sequence that plays out with stunning consistency. Phase 1 is irrational staying power. Markets stay high longer than anyone thinks rational. We are here right now. The disconnect from reality feels absurd, yet prices keep climbing. Phase number 2, crash fatigue. Investors become numb to bad news. Inflation, layoffs, earnings warnings. None of it moves the market anymore. This is classic pre-crash behavior. When bad news stops mattering, that's when you should worry most. And here's phase 3. A single event shatters confidence. A major bankruptcy, a credit event, some company not being able to produce chips anymore. The chain reaction begins. Selling accelerates, and the crash everyone expected months ago finally arrives with devastating speed. Here's the cruel irony. You can't just hold cash and wait this out. Inflation is running 3 to 4% annually, which means your purchasing power is being systematically destroyed. You're being punished for prudence and pushed towards speculation. The system is designed this way. So what do? The wealthy protect themselves by positioning outside the system's reach. They own assets that produce income, land, businesses, intellectual property. They hold real value that can't be inflated away. Gold, silver, scarce commodities. Financial sovereignty begins with intellectual sovereignty. You need to understand how the game is rigged before you can position yourself properly. So here's the inevitable snap. The market hasn't crashed yet because the 3 hidden forces, the money flood, AI concentration, amplified by passive investing, and shadow banking, are holding together the illusion. But physics don't change. You can't expand claims forever without real backing. When the collapse comes, it'll be sudden. Confidence will evaporate and selling will cascade. The longer this delay continues, the more violent the eventual correction becomes. The crash isn't canceled, it's queened, and it's getting bigger every single day that we wait. Only those who saw that structural weakness beforehand will be positioned to seize the massive opportunities created by forced liquidation. So here's the truth. Are you going to buy hard commodities like gold and silver and have the real stuff, the money that was used to hold the money standard for centuries? Or are you going to ignore all the facts presented in this video and others and await the inevitable? Remember, history doesn't repeat, it rhymes. And right now you are ahead of the curve because you realize the trouble we are all in and you're going to do something about it.